People believed the internet would make everyone rich until trillions disappeared. In 1995, one initial public offering turned Netscape into a $2.3 billion company overnight and rewired how Silicon Valley thought about money. Venture capitalists poured $21 billion into startups that had never earned a dime. The Nasdaq hit 5,132. Then $5 trillion vanished. The crash that changed Silicon Valley forever began with a single question nobody thought to ask. August 9th, 1995. At 9:30 a.m., Netscape Communications made its debut on the Nasdaq. The opening price was set at $28 a share, but within minutes the stock rocketed as high as $75. By the end of the day, Netscape's market value had soared to $2.3 billion, a figure that stunned even the most seasoned traders. Just 16 months after its founding, a company built on a web browser had become Wall Street's hottest commodity. Jim Clark and Marc Andreessen, the company's founders, watched as the world suddenly treated their software as a golden ticket. Reporters crowded around the trading floor, searching for the logic behind this surge. But the old rules, steady profits, and proven business models no longer seemed to matter. Instead, investors were fixated on something new: potential. If a company could capture millions of users, the thinking went, profits would eventually follow. Netscape did not need to show earnings. It only needed to promise a future everyone wanted to believe in. This was the moment Silicon Valley's mindset flipped. The market had just shown that a startup with no profits, built on the raw possibility of the internet, could command a multi-billion-dollar valuation overnight. The message spread instantly. Venture capitalists began chasing any company with a .com in its name. Entrepreneurs and bankers started measuring success not by revenue, but by reach, by how many eyeballs a site could attract. If a web address could spark this kind of frenzy, why bother with the slow grind of profit and loss? Netscape's IPO was not just a windfall for its founders. It was a signal flare for an entire generation. The rules had changed. Hype, hope, and the promise of digital gold had replaced the old calculations. In that single trading day, the seeds of a bubble were sown. Money poured into Silicon Valley at a rate the industry had never seen. Between 1995 and 2000, venture capitalists invested over $21 billion across 441 internet startups. The numbers were staggering, but the logic felt simple. If one Netscape could create instant billionaires, why not 100 more? Boardrooms buzzed with the promise of first-mover advantage and network effects, phrases that turned every pitch into a potential goldmine. Venture funds ballooned almost overnight, with partners scrambling to stake claims in anything with a .com at the end of its name. The media stoked the fire. Magazine covers blared slogans like, "Get rich quick on the net." News anchors described the Nasdaq's rise as a once-in-a-lifetime event, while CNBC and CNN ran daily stories on the fortunes being made. Headlines promised a new era of prosperity, and every startup founder became a minor celebrity. The hype wasn't just in the business pages, it spilled into mainstream culture, fueling a sense that anyone, anywhere could cash in. Ordinary people wanted in. Online brokerages like E-Trade and Charles Schwab slashed commissions, opening the doors to millions of first-time investors. Suddenly, buying stocks didn't require a Wall Street connection, just a home computer and a credit card. Day trading became a national pastime, with message boards and chat rooms swapping hot tips at all hours. The line between professional and amateur blurred as retail investors began moving markets with the click of a mouse. All the ingredients were in place: easy money, relentless media hype, and a mass of eager participants convinced that the old rules no longer applied. The stage was set for valuations to break free from reality, as companies with little more than a website and a dream found themselves at the center of a financial superstorm. Pets.com became the most recognizable face of .com excess. The company launched its IPO in February 2000 at $11 a share, raising millions on the back of a sock puppet mascot and a promise to revolutionize pet supplies. But behind the grinning puppet, the numbers told a stranger story. Pets.com spent more on advertising in a single year than it made in total revenue. The Super Bowl commercial alone cost nearly $1 million, yet orders never caught up to the hype. Traditional measures like profit and loss were pushed aside. Investors fixated on new metrics: how many people visited the website, or how many eyeballs saw the brand. Price to sales, or PS, replaced earnings as the yardstick. For most companies, a PS ratio above 10 would raise alarms. At Pets.com, revenue was so tiny that the ratio was effectively meaningless, but the market did not care. The company's entire lifespan as a public company lasted just 268 days. By November, it was over, with more than $300 million in investor money gone. The sock puppet became a punchline, but the real lesson was that hype, not fundamentals, had set the price. Every internet startup in the late 1990s had a single obsession: grow as fast as possible no matter the cost. But beneath the excitement, the numbers told a different story. The first number every founder watched was the burn rate, the amount of cash a company spent each month just to keep the lights on. For many dot-coms, this meant millions of dollars flowing out the door every 30 days, with little or nothing coming back in. The next number was runway, calculated by dividing the cash left in the bank by the burn rate. If a startup burned through $10 million a month and had $50 million on hand, it had 5 months before the money ran out. Another key measure was the relationship between customer acquisition cost, called CAC, and lifetime value, called LTV. CAC was what it cost to win a new customer, often inflated by massive ad campaigns and discounts. LTV was how much that customer would ever spend. For a business to survive, CAC needed to be less than LTV. But in a rush to dominate the market, many dot-coms paid far more to attract users than those users would ever return. These metrics were ignored or downplayed, replaced by the belief that scale alone would solve everything. Yet as the cash piles shrank and profits remained out of reach, the cracks in the model began to show. On March 10, 2000, the Nasdaq Composite reached heights no one had dared to imagine. The index soared to an intraday peak of 5,132 before closing at 5,048.62. Headlines called it the dawn of a new era. Television anchors marveled at the numbers, while business magazines ran cover stories celebrating the internet's unstoppable rise. In Silicon Valley and on Wall Street, the mood was electric. Cheers erupted in trading rooms, and startup founders toasted to what seemed like limitless futures. Every tick upward felt like proof that the old economy had been left behind. Investors, both seasoned professionals and first-time day traders, crowded around screens, watching the digits climb as if gravity no longer applied. The Nasdaq's record was more than a number. It was a collective high, a moment when belief in the internet's promise reached its purest, most euphoric form. Yet beneath the celebration, a quiet sense of unease began to settle in. The market had never felt so invincible or so precarious. On April 14, 2000, the Nasdaq plunged nearly 10% in a single day. In just one brutal week, the index lost a quarter of its value. Trading floors that had buzzed with confidence now echoed with shouts and frantic phone calls. Margin calls began to hit, forcing investors to sell at any price. For every day trader who had borrowed to chase the rally, the sudden drop meant their brokers demanded cash they didn't have. Forced liquidations triggered more selling, which drove prices even lower. The spiral accelerated. Stocks that had soared on hope now collapsed under the weight of panic. By the end of 2002, the total loss in market value reached $5 trillion. Investors watched years of paper wealth disappear in days. What began as a correction turned into a stampede for the exits, as liquidity dried up and buyers vanished. The easy money era ended not with a whimper, but in a cascade of selling that swept away fortunes and erased the confidence that had fueled the boom. Webvan stood as the most ambitious and costly bet of the dot-com era. At its peak, the company's shares hit $34, giving it a market capitalization of $7.5 billion. The plan was bold: a national web of automated warehouses, fleets of climate-controlled vans, and the promise of groceries at your door within 30 minutes. But the cash burned faster than the groceries could be delivered. Warehouses sat half empty, order volume lagged far behind projections, and each delivery lost money. By July 9, 2001, Webvan filed for bankruptcy. The collapse wiped out not only investors but thousands of jobs, and the dreams of an entire workforce who had believed they were building the future of shopping. Webvan's fall was not an isolated event. Over 300 internet companies filed for bankruptcy between 2000 and 2002. Office lights flickered out across Silicon Valley, and the layoffs rippled far beyond the valley's borders. The crash was no longer just a story of lost billions on paper. It was a wave of broken promises, empty cubicles, and careers cut short. Speculation still fuels Silicon Valley, only now the mania wears new names: AI, crypto, and tomorrow's next big thing. Nearly $5 trillion vanished in 2000, yet the dream of easy riches endures. The real lesson? Hype will always tempt us, but gravity always returns. What are we chasing now?